In this video, we continue our study of the FIFO and LIFO, and we're looking at specifically the advantages and the disadvantages. Now, keep in mind, these are two different inventory valuation methods. We make an assumption that what we sold was first in, first out. Now, under LIFO, what we sold were the last ones in, and what remain unsold are the old ones. Now, a company can only use one valuation method. It can either choose FIFO or it can choose LIFO. But once it's made that choice, it cannot change. Now, most companies choose FIFO because FIFO in times of inflation show a higher profit. So therefore, the advantages. FIFO method has four major advantages. One, it's easy to apply. Two, it makes sense. It assumes that we sold the older ones first. We bought them in first, we sold them first. So in a way, it makes sense. There's no way we can manipulate income. And secondly, though I expense the old ones on the income statement, which gives me a higher net income, my balance sheet is accurate, because if I was to lose all my inventory due to fire, the replacement cost of that inventory would be, under the FIFO method, the same as the latest purchases. So the value of the inventory would be at the current market value. Now, some of the advantages of LIFO are the disadvantages of FIFO. And so what we look at here primarily, the disadvantage of FIFO, is that we have what are called paper profits or inventory profits. And LIFO supporters claim that this upward trend in prices that has been going on for decades results in FIFO having higher profits. There is a tax benefit to LIFO because the LIFO method results in a lower taxable income, therefore lower income taxes. Now, all of this was a big issue in the 70s, 80s, and a little bit in the 90s, but we have not had major inflation for quite a while now. So it doesn't matter in LIFO and FIFO. If there's no inflation, they show the same net income. Now we move to the journal entries that we would record in a perpetual inventory system. Now, in the past videos, we looked at the journal entries for a periodic inventory system, so that when I bought in goods, I charged an account called purchases, and when I returned them, I charged an account called purchase returns and allowances. Here, though, we only have one account in perpetual inventory, and that is a merchandise inventory account. Merchandise inventory. And that's it. Every time I buy inventory, I debit it, and I credit the accounts payable. When I sell inventory, I credited it because it goes down. And so in the next video, when I sell, then the journal entry is the same under both debit accounts receivable and credit sales. But under the perpetual inventory system, I have another entry to make, and that is to recognize the cost of goods sold, because I know exactly how much the item was. It was $80 that I sold, and to take it out of inventory. And so therefore I reduce the inventory account by the sales. Now, because every time I make a sale under perpetual, I have two journal entries. Same thing happens when I have sales returned to me. Again, the same journal entry we had before: debit sales returns and allowance, and credit accounts receivable. The person no longer owes us. However, I must put back into inventory the item that was returned. And so therefore I debit merchandise inventory and I reduce the cost of goods sold. So sales returns affect both revenue and the cost of goods sold, because the goods charged the cost of goods sold are actually returned to the seller. In contrast, though, if I had sales allowances, then I make the first journal entry up here, but I don't make the second one, because I didn't receive the goods. I only gave an allowance. So those are the journal entries that you have to make if you are recording purchases and sales on a perpetual inventory system. And it's really quite simple purchasing. When I buy, it goes up. When I sell, it goes down. When it's returned, it goes up. When they take a discount, it goes down. Okay, so I only have one account, and because it's perpetual, I always know what my cost of goods sold is. So then on the income statement, I could say sales 1 million less cost of goods sold, cost of sales 600,000, and I get my gross profit 400,000 very easily. Recall that under the periodic, I had to do sales or net sales, and then I had to do beginning inventory, purchases, less purchase discount, plus transportation in. Oh yes, any transportation in cost, I debit merchandise inventory. So the journal entries the accountant makes for a merchandise company that is on a perpetual inventory system is quite a bit simpler than it is under periodic. And that concludes our recording and valuation of inventories.